I'm a tax attorney. I used to be a prosecutor. I don't do that stuff anymore. So Joe and I were kind of teasing each other. I don't put people in jail anymore. My job is to keep you out, all right? And to help you make money. And so one of the things we're going to hit is a concept, a tax idea. Now we're not going to go down a big, dark tax rabbit hole. I promise you that. Unless you want me to. Then it's your fault, not mine, all right? What we're going to do is talk about a concept I call the buy-sell LLC. This applies to business owners. So it should apply to most of you in the room. And one of my best friends in the whole world, his name is Mike Hinton. He lives in Omaha, Nebraska. He owns the biggest landscaping company there. So I've known Mike since the first grade. We went all the way through our second year of college together. Then he dropped out. All right. He and his wife Deidre are extremely freakishly successful. He started his own landscaping company, and just he's one of those people that just knows how to make money, like we're referring to this morning. I don't know how he does it. He just knows how to make money. So this is a concept that he and I have talked about because he has a little inner tax geek in him too. He doesn't like to admit it. He likes to work with his hands because he's kind of cerebral as well. And this is something that I think you might be interested in. So you're a business owner. What are you thinking of? It's 2 o'clock in the morning. You're maybe 50-ish. That's what I am. How do I become independent in my own business? How do I separate my personal wealth from my business wealth? Does that ever occur to you? Does that go through your mind sometimes? All right? I see some nodding heads. Another question is, what's my business really worth? What is it really worth? Who am I going to transfer this business to? Under what circumstances? When? Are my kids even interested in this business? Is one of them interested and the others maybe the black sheep of the family? Every family has a black sheep. Arguably, I'm the one in my family, according to my siblings. Maybe one of you are a black sheep. So who am I going to transfer the business to? Is that successor worthy and competent to obtain the business? So, my company, just a small little plug, and one Joe works quite a bit with, it's Meredith out of Lincoln, Nebraska. A lot of the concepts, ideas that we come up with, my team, are business owner-focused ideas. Because in my mind, that's where the future of real planning is around you. A lot of us, might be very well off. I've talked to a lot of you just this morning, and that's great. So a lot of you might have estate tax issues or inheritance tax issues. But what we all have is business succession issues, how to extract personal wealth from the business wealth. And this is the concept I want to hit, the buy-sell LLC. So how many of you, I'll start out this way. I could ask questions, right? How many of you have an LLC? Oh my God, this is going to be perfect. No wonder you wanted to talk about this topic. All right. So you have an LLC. So this concept might work well. I'm going to return to LLC in just a moment, but I'm going to back off that just a second. How many of you have a buy-sell agreement? All right. For a couple of you that raised your hands, I don't mean to put you on the spot, but why do you have the buy-sell? Why do you even have it? What does it do for you?
Because my brother, my partner in the body, what he does, I can't do, and what I do, he can't do. So I raise money, and he does other stuff. If I die, maybe he can raise money, but I wanted that income for my wife and my family.
Right. So, and that's perfect. I mean,
but if he dies, I can't do what he does. So that's all over. So that works well for me as well.
Yeah, it's a two-way street, and that's exactly right. He has a unique set of skills. You have a unique set of skills. You need to be able to go ahead and insure against the possibility of one of you might not be around. And we'll talk about how to structure that and how that works in just a little bit. So I'm not even going that far yet. Awesome answer, though. Anybody else that has a buy-sell? Why do you have a buy-sell agreement? Yeah. So you're insuring each other. You're essentially creating liquidity for your family because you don't want your brother necessarily to be in business with your family because your business interest is going to go to them. Wouldn't it be nice if they could be bought out? Essentially, that's what we're looking at. Anybody else? Anybody else have a buy-sell agreement per se? All right, we're being honest with one another. When I say buy-sell agreement, you know what the heck I'm talking about, right? All right. How many of you, this is going to make sense in a second, how many of you have a personal will? Just a will. All right. Why do you have a will? Almost everybody raised their hand on that one. Why would you even have a will? What happens if you don't have a will? Probate, intestate, things like that. The state comes up with their idea of how your assets should pass. And usually it's in a way that you don't like. There's situations where you might have assets passed to in-laws, outlaws, and others. All right, so you have your own will. A business succession agreement, a buy-sell agreement, is a will for your business. That's what that is. It's how you want your business transferred and under what terms. Most buy-sells have valuation provisions in them. How to value the business as well. So that's all we're trying to do with a buy-sell agreement. So good. So that's kind of business succession 101. So it's a binding contractual agreement. So when I first came in here this morning, there was a gentleman who I met. Steve, is that you? Okay, I remember. So let's say you and I have a Acme Corporation, all right? We're 50-50 owners of an S Corp. Typically what we'll do is we'll have a buy-sell agreement, and that'll insure against lots of different contingencies. What if you leave? What if you die? What if you become disabled? And the same for me. And most of the time attorneys will draw this up for you. So it's a good idea to have a business succession agreement. Typically, that'll prevent disputes, and you're going to want to have to be able to value that business relatively accurately. Most buy-sells that I see, business succession agreements that I read and my team looks at, they are not funded. What I mean by that is we have a contingency on what happens with the business interest. So Steve, you pass away, I have to buy out the 50% interest in Acme Inc. We have the S Corp. I have to buy it out. That provides liquidity for your family. Where's the money come from for that? What's that?
The business.
That's often the answer. And what's that? The business. The business has to pay for it. So often that'll mean like an installment note arrangement of something or something like that. Wouldn't it be nice if the liquidity or the cash existed so that I didn't have to drain business assets to pay off his estate? And that's where life insurance comes in, where we might have a life insurance policy on one another. All right, so I die, I'm the speaker, Steve, I'm gonna have to kick you off, all right? Let's change that. You die, we'll do something called a cross-purchase agreement, all right? Where we'll just own life insurance on one another. You die, proceeds go to me, I could buy out your business interest. It works pretty well that way.
Isn't that key man? Isn't that what that is?
That's a little different. So Steve's asking whether or not that's key man or key person insurance. In cross purchase, we own life insurance on one another. I own a policy on you. You die, proceeds go to me. I buy you out or your estate out. Key person is when the business is the owner, the business is the beneficiary, the business is the premium payer. So that's different. You're a valuable employee. I can't replace your skills very readily. I'll insure your life. You pass away. Proceeds go to my business. I use those monies to replace you. I'm talking about something different. That's a buyout between like peers, owners of a business together. Does that make sense? Okay. So that's kind of what we're looking at. When I look at life insurance and buy-sell agreements, since very few of them are actually funded, it's like an unfunded mandate from the government. It's an obligation, but it's not funded in any way, shape, or form. So we talked about cross-purchase a little bit. And I promised on a Saturday not to go too far into tax land, but I'm going to have to just a little bit, right? Got to give you your money's worth here. So we talked about that cross-purchase agreement. Does that make sense, kind of at a basic level? So what happens if we add Joe? You're in our business. 3 of us, still an S corporation, all right? So we got Steve, Joe, and Andrew. We have a cross-purchase agreement. How many life insurance policies, let's say we want to fund this, because it makes a lot of sense. How many life insurance policies would we have to have if there was 3 of us under my scenario? Who said 6? Why 6? Why not 3?
You gotta have one on Joe and Steve, and he's gotta have one on the other 2, and then the other guy's gotta have it on the other 2.
You're correct. That's exactly right. So we got an advanced group here. So the more owners you have of the business, it's a formula. It's called N times N minus 1. The more policies you're going to have, it becomes very unwieldy. Now, us tax geeks, people like me, and some of the CPAs, we love cross-purchase agreements. Why? Because you'll get something called a basis step-up. And that's a tax thing. Most of us, you're business owners, you understand the importance of basis. Usually the higher basis you have, the better off you are. More money that's shielded from taxation. So back to Steve, you and I for a moment. You pass away, I get the proceeds on your life. I purchase your business interest. That basis and that interest that I'm purchasing gets stepped up to the purchase price. That's a really good thing. That's a tax advantage. Life insurance is awesome. Not only are those death proceeds tax-free to me, but I can get a basis step up on the purchase price of the business interest that I'm getting from you. Huge deal. Now can you see why funding these buy-sell agreements is so really, really important? I get advantages I can't get anywhere else. So, and we're going to get to the advantages of putting life insurance within an LLC in just a moment. This is just kind of precursor work. So the other thing we have is, we got complexity if we got too many owners. The other type of agreement you could have is what we call an entity agreement. Some people call them stock redemption agreements. That's kind of a misnomer. They're very easy. We simply have the business as the owner, beneficiary, premium payer. Not to confuse apples and oranges, but it kind of feels like a key person policy, doesn't it, from the way I just described it? So this time we're resurrecting you, Steve, and we're kicking off Joe, Mr. Pantozzi here. So he's dead now. Proceeds, we're doing an entity agreement. Proceeds are going to go to the business itself, and the business is going to effectuate the buyout of Joe's business interest. So it's the business buying it, not the individuals like a cross-purchase agreement. Do you see the distinction here? All right. You can get this next point, you're going to have like the next 45 minutes down pat. Okay, this is really easy. With an entity agreement, the business is the owner, beneficiary, premium payer. You're generally not going to get a basis step up, at least not in the same way as a cross-purchase agreement. You might be thinking, that's just a nerdy little tax point. Let me assure you, it makes a big difference. It should make a big difference to you because your CPAs and your tax attorneys are going to be very interested in that. You want to have a basis step up. You get that with cross-purchase. Entity agreements, you either don't get it or it works in a different way and it doesn't give you the tax impact that you need. No basis step up generally. All right, so that's the precursor to us going through this awesome concept of which we're going to fund with life insurance. Any questions on cross-purchase or entity purchase so far? We good? All right, that's good.
Yeah, I got a question. So in the cross purchase, does I own a policy on you, you own a policy on me. But if the LLC is paying for it, do you still get the step up?
I don't care where the funding is. I don't care where the funding is coming from with a cross-purchase agreement. As long as I'm the beneficiary of that policy and I do the buyout, you're going to get the basis step up, whether the LLC funds it or not. Doesn't make a difference. All right. Everybody understand the question? Okay. All right. So let's move. Let's see if we can go on here. So let's talk about this concept. Most of you raised your hand when I said the LLC. I may or may not need this, so I'm just going to get it ready. For those of you that raised your hands, why do you have an LLC as opposed to like an S corp or a C corp, or is it because your accountant told you to, or your CPA? Did any of you really know why you have an LLC? Yes, ma'am.
I have both. I have one for me, that's the S corp, and then one LLC for the building that I own. And I did the LLC because it's a building, and I did the S corp because it was me. That may be totally wrong.
No, that's fine. Do you like a lease back arrangement of some sort?
Yes.
Yeah, that's a big reason people do that. You have an S corp, then you have an LLC, and you'll do a lease back arrangement because you have a building. That's actually very common. You're good. Okay. This isn't confession here.
I'm an LLC because I'm required to because of my profession, but I file as an S corp.
Right. So you file as an S corp because you have an L.
But my legal designation is a PLC.
Okay, professional liability corporation, right? Okay, that's fine too.
Okay.
All right, so there you go. All right, so I didn't know it was going to go in that dark direction. So the whole Irish Catholic thing is starting to come out here. So LLCs are awesome vehicles. Traditionally, it's been my experience that people really don't understand truly how impactful LLCs are from a life insurance perspective. And that's why I'm here, to talk about the life insurance part of it. And this is going to be a nice bridge for kind of like infinite banking, be your own banker sort of a concept. Because I'm going to talk about the value of permanent life insurance within an LLC. So let's do that now. So we're going to start out very basic. You have to stop me if you have questions, all right? So one policy per owner. You have an LLC. You have an LLC. The LLC is going to be the owner, beneficiary, premium payer. I'll go into the tax advantages in just a moment. Just stay with me. I'm just giving you the structure for right now. All right, so it's going to be walking and talking just like that entity arrangement. Why would you want to use an LLC? So I'm going to forecast the two reasons, then I'm going to go into how they work. An LLC will allow you to have your cake and eat it too. You could have one policy per insured no matter how many owners you have, and still get a basis step up. All right, I'll show you how that works. Number two, and this is the part that I like the best, is you could use this business entity as a funding vehicle for your own retirement. Why not use business money within an LLC to fund your own retirement? That's the whole idea of separating your personal wealth from your business wealth. Traditionally, even people in my profession have used different policies to solve those needs. You got a retirement planning need, maybe you own the life insurance policy separately, you pull money out of your S corp, and it's like a supplemental income tool. There's nothing wrong with that, all right? With a buy-sell need, I'll fund my business with life insurance. I might do a cross purchase. I might do an entity arrangement. You know what? I'm going to do it on the cheap since it's probably a temporary need. I'm just going to do term insurance. We all know that never pays anyways, but that's traditionally how it's been done in the past. But if I could show you a way to use an LLC using permanent insurance where you could do the business succession, get the basis step up, one policy per insured, and get that money back out tax-free. Is this working anymore? Hello? Stopped working. Does it have a battery? Hello, hello? It's all right. I'll just talk louder. Okay, can I just do this? Is this better?
Yeah.
I don't like holding the mic anyways. Makes me nervous. All right. All right.
When you say LLC, when you're referring to it, you're talking versus an S corp or C corp or an individual. Is that what you're saying?
That's what I'm saying. A limited liability company, which is separate from an S corp. You have different types of business entities. You could form it as an S corp. You could form a C corp. This is an LLC. So you could go to the Secretary of State and you could have an LLC.
Not a PLC like this one.
Not a PLC. We're not going to go down that road. That's a 202, and this is a 101 course. We're going to talk about a basic LLC right now. All right.
Not LLPs either.
No LLPs.
LLC.
LLC. Plain Jane. All right. Got it? Okay. So we have an LLC. It's going to give you the best of both worlds. You could have business succession. All right. One policy per insured, basis step up, what I like the best is you can get these policies back out of the LLC tax-free. Now, when I do this presentation in front of CPAs, I usually add this last part, but I've got some good questions so far, so I'm going to throw it in here because I think you guys might get this. Let's say we did, who had the S Corp? What was your name?
Sue.
Sue? So Sue, you have an S Corp. Let's say we wanted to do a life insurance within the S Corp. We wanted to do business succession with it and use it to build your own wealth. We could do that. There's nothing sinful about that kind of religious thing. We'll just keep with it, right? All right. Nothing wrong with that. The problem is, couple, if you and I are business owners and I die, those proceeds will flow into that S Corp because it's an entity arrangement, and they're not going to give you the same kind of basis step up that you would otherwise get. If that bores you, that's cool, but what's most important, what shouldn't bore you, is that those policies aren't going to come back out of that S Corp very easily. If you want to do double duty with life insurance, if you want to use life insurance to supplement your retirement, to build personal wealth, S Corps are one of the worst vehicles to hold them in. Why? Because you pull that policy out of that S Corp, even if it's your own policy, Sue, short-term memory, if you pull that policy out of your own S Corp, the value of that policy is fully taxable to you. So let's say you have $2 million worth of death benefit and $500,000 worth of cash. Even though you're the insured and you want to get your own policy, it's $500,000 worth of taxable income to you. Furthermore, if there's any equity in that contract, the remaining shareholders have to pay tax on that equity according to the pro rata rules. S Corps are a disaster when it comes to personal retirement. LCs are a lot more effective. Get the life insurance out of that S Corp, stick it into that LLC. Let's go through how that's going to work. All right, so let's say we have Sue's S Corp, all right? And we're taking money out of that S Corp. Let's say we're taking a K1 distribution out. One of the reasons we have S Corps is because we want to save money on payroll taxes, minimize the W-2 income, maximize the K1 distribution because you're not paying payroll taxes. So we're taking money out. Yes, that's taxable. It's tax advantaged money, arguably, because it's a K1 distribution. Stay with me here. You're taking this after-tax money, which you're going to be taking out anyways. Why not, rather than taking out individual policies via a cross-purchase agreement, why not use an LLC and make a cash contribution to the LLC? Us little tax guys call that a capital contribution, and there's a reason for that. I'll go into that in a second. So we're putting money into the LLC. It's coming out of the S Corp. Make sense so far? I'm getting a couple strange looks. You're taking it out, it's taxed, we're putting it in the LLC. The LLC is going to use that money to buy life insurance on the owners, on you, whoever the owners are. Again, that LLC is the owner, beneficiary, premium payer. So it kind of walks and talks like that key person Steve and I were talking about. So it's Steve, Sue, and Andrew. Let's make it our little business. We're going to remove Joe for a moment, all right? Let's say we drove him away. So it's just the three of us. We're going to have a policy on each of us. We're going to want to make sure those are permanent cash value life insurance policies, not term. We're going to use company money to fund our retirement. We're putting money into these policies. Now we have a buy-sell agreement at the same time, so this is going to work that way. A couple different things can happen. This is complicated stuff. You're either going to live or you're going to die. I'm going to show you both arrangements, how that's going to work from a tax perspective. LLC is going to use these bonuses to purchase policies on each of you, and you're going to have two things happen. Either the business interest is going to be purchased, or it's not, and you're going to use it for your own retirement. Let's start with something positive. More likely than not, with Sue, Steve, and I, we're going to, how should I say this, exit the business vertically rather than being taken out horizontally, all right? It's a lifetime exit. That's most likely what's going to happen. Traditionally, I told you what happens with the S Corps. If you have life insurance, even if you're the insured, it's hard to get those policies back out. This is the best part of this concept. With an LLC, you could take these well-funded permanent cash value life insurance policies and pull them out tax-free. They're considered to be part of your share of the LLC. These capital contributions which you are using to fund the LLC are in effect, you're getting credit for them. These policies are going to be coming back out tax-free. Even if there's gain in these policies, another insurance term for any kind of money you put in a policy, that's considered what we call basis, premiums paid. And if you have gain in those contracts, which you will with whole life insurance, you're going to have what they call the fair market value of that contract. You're going to be in a gain position. That gain's not going to be taxable when it comes out. You're going to get your policies back out tax-free and not have to pay tax on that gain. These policies could be used to supplement your retirement. It can be used to pay for your retirement. You can take the money out of it, withdrawals up to basis, tax-free, loans after that, tax-free. You can't do this with any other vehicle, and you don't want to do this with term insurance. You want to do this with permanent insurance. Use company dollars to fund your own retirement. Use company dollars to become independent of your business. Use company dollars to do double duty with your hard-earned money. Use company dollars to accomplish more than just one goal. If you have a smart solution, we like to talk about smart solutions. It's doing multiple things with your money, and this is what this is all about. All right, I'm going to hit the second part. The part I just talked about is the part I have the most fun with, which is getting your money out tax-free. Any of you that raise your hand that have LLCs are getting an inkling, hopefully, of what I'm talking about here. Any questions, thoughts, things that spring into your head? Sue, yeah.
What happens if you sell the LLC
Before any of this happens,
before any of this happens?
it's treated.
You have the policy, you buy the policy, you're funding the policy, and now the LLC is a building, and you sell that building. What happens to that?
Yeah, the LLC owns the life insurance along with anything else that's in the LLC. That's a company asset. That's a corporate asset in effect, which has value, just like any other piece of property. That can be sold along with it, or you could pull the policies out before you do that and just take your own policies and walk away if you want. The transactions that I've seen with this, most policyholders want their money out, want to take their policies, because the whole idea of them doing this is typically to supplement their own retirement. They'll pull them out and then just sell the LLC separate. That's typically what they'll do. Awesome question. Yes?
What do you see as being a common practice to establish fair market value at the selling company with a whole life insurance policy and its asset space?
Okay. So you're asking about kind of fair market value of the life insurance when the underlying business is being sold?
Right.
Yep.
We have different metrics for different types of businesses and places, but then as an asset class, whole life lives differently
Yeah.
than the business itself. So is there a fair market value to unique based just on this?
Yeah. Yeah. Well, typically, if you want,
Valuation and net present value.
yeah, I mean, if you want to value just the policy, underlying policy itself, you're going to want to go to the insurance company. There's a form called a 712. You're gonna great asking the question, but if you want to value that asset, if you're selling the underlying business and it has life insurance, you want to value the life insurance, ask the insurance company what it is, request a 712, and we'll give you what they call the interpolated terminal reserve value of that policy, which will be the value of that for sale purposes. It's called the interpolated terminal reserve. That will be the value of that asset, the life insurance asset, for sale purposes. Ask us, we'll give it to you. And make sure you ask. So I warned you guys about the people that asked the questions. So it is a 712 form, hugely important. Ask us for it. A lot of companies that have life insurance have troubles valuing the asset, and they're pulling out their hair on it. Ask us for it. We'll give it to you every time. There was another hand. Yeah.
The
policies that the LLC owns, if you want to take it with you for whatever reason, whether you're selling the company or whatever, is it just transferring ownership to the individual then, or how's that process?
How's the
Do you
process?
buy it, or?
Yeah, how's the process work? So I've talked about getting ownership. What does that mean?
Right.
Right? Okay, that's a great question. So, and I'll make it sound simple on the front end, but it's harder than that, all right? So the simple end is you request a change of ownership from the LLC to the individual. So if I'm the insured, you're the insured, you just request a change of ownership form from the insurance company. And that's how it's done. The LLC owns it, they're changing ownership over to you. Now from a tax perspective, we want to make sure that that's considered to be equal to what your interest in the LLC is. That's up to the LLC members and their accountants.
Okay.
But it's a change of ownership form.
Right.
All right? Good
So
question.
If it does go to an individual, as you suggested, does it become a taxable withdrawal at retirement? Is it then taxable?
So when you do that change of ownership and it goes, what's your name?
Michelle.
Michelle. I don't like to call her. So Michelle
Thank you.
goes to Michelle. Yeah, the whole point is Michelle's going to be able to get this back out tax-free. This is essentially her capital contribution, which she put into her own company to pay for the life insurance to begin with. Usually when I do this presentation, we're not getting into these specifics, but you know what? This is good. I know. So, and anything else on this before I talk about awesome things like basis allocation and things like that? No?
I have
Good?
one quick question.
Yes.
So if you have the Andrew, Stevens, and Sue LLC, do they all have to be funded equally? In other words, you might have a bigger policy or a more expensive one because you smoke or you drink or whatever. So I don't know if you want to get into that, but
I do. I'm afraid to get into that because you guys are thinking, all right. So does everybody understand what Steve just mentioned? Like, there's going to be age discrepancies, health discrepancies. The chance of those premiums being different are huge. We're going to be putting in different amounts based upon, because we're just different people. A huge disadvantage of a cross-purchase agreement where we each own it on each other is we're essentially subsidizing each other's age and health. And that upsets a lot of people that want to do cross-purchase agreements. I usually don't talk about this part, but a third advantage, the secret advantage of LLCs, which you're making me talk about, is that you put the money into the LLC. Stay with me on this part. The tax attorneys get all giddy on this next part. You put the money into there, you could allocate those monies going into the LLC however you want. So even though there's a discrepancy with premium dollars, we can agree among the three of us how we want to allocate those monies going into the LLC to increase maybe your basis account more than Sue's, or vice versa. And the legal rationale behind that was LLCs have to abide by something called the economic substance doctrine. That gives you flexibility as far as how you allocate capital contributions going into an LLC. So yes, there's going to be a difference because we're different individuals. The premiums are going to be different, but you can normalize all that within the LLC. You can't do that with an S corp. You cannot do that with a C corp. Only an LLC has that economic substance doctrine. All right. Thanks for asking that. All right. Anything else on that part? All right, this is good. Oops, I went ahead of myself. Okay, so death. So, Sue, we're going to kick you off. All right? You could stay in the room. So, Sue dies. The death proceeds are going to go to our LLC. Now, stay with me on this part too. We are still going to get a basis step up. The same sort of basis step up as if we had a cross-purchase agreement. How does that work? Money goes into the LLC. This is what we call a conduit tax entity. I swore when I was in law school and my professor was talking about conduit tax entities, I would never, ever bring it up again. Now I have to. What is it? All a conduit tax entity is the money flows through the business and goes directly to you. You're taxed, not the entity itself. It's conduit. You're taxed on everything going through it. All profit and losses go to the owners of the LLC. That's what an LLC is. It's taxed like a partnership. Why do you care? Why do I care about that? The money will flow through the LLC, the death proceeds in this case. Remember, death proceeds are tax-free, as long as you don't screw it up. Then Steve, you and I in our individual capacity, so let's say it's $1 million death benefit on Sue. We'll each get a $500,000. That $500,000 is going to go through the business to us. We're going to go ahead and buy out Sue's business interest. And our basis, just like with cross-purchase, will be stepped up. It'll be stepped up to whatever the purchase price was for Sue's business interest. So that's how you could use an LLC, have an entity agreement, just one policy per insured, and still get a basis step up just like you would with a cross-purchase agreement. Why? Because you're using the right type of entity, or using an LLC. That's smart tax planning when it comes to life insurance. Yes,
There's
Michelle.
cash value in that policy. Does that just get distributed evenly or however the contract reads, or does that mess them up?
In my death time scenario,
Uh-huh.
well, then the life insurance policy transforms itself into just the death benefit, because the cash value you have access to during life, withdrawals up to your loans, you can take those, and withdrawals, et cetera, et cetera. But at death, you have a contractual right to something even better than the cash value, which is the death benefit. So the cash values go away, and it's that leveraged up death benefit that's going to provide all those tax advantages. All right, that's good. So that's that. This is like the disclaimer slide. I'm going to hit a couple of these. You guys may or may not be interested in this, but with some of the questions I've gotten so far, you never know, and they might bring out some other points. Some of the attorneys that I usually present this in front of have an issue kind of with, doesn't this cause estate inclusion? Generally not. The amount you could pass tax-free to the next generation these days between a married couple is about $11 million. Some of these proceeds might flow through the business into your estate. It's generally not going to be a big issue. So I don't really get into that too much. This is the big one though. I've talked about, funding this LLC with life insurance and with all the multiple advantages that it has. What if you don't have an LLC? Can you just stick life insurance in it and do all these wonderful tax tricks that we were talking about here? It depends on who your accountant is. If it's Joe's accountant, the answer is yeah, sure, you could go ahead and do it. No, the answer is to be conservative. I mean, it's not just because I'm from Nebraska. I think it'd be very smart. If you don't have a pre-existing LLC, you could form one, put the life insurance in it, but it has to have some business purpose beyond just the life insurance. So maybe do a leaseback arrangement with an S corp or something of that sort, like Sue's doing. Exposure of life insurance to creditor claims, it depends on the state. I kind of talked about this a little bit because I got the question from Steve on that, which is good. COLI best practices. All that means is if you take out a life insurance policy and it's going to be owned by an entity, and a lot of these owners are also employees as well, you have to go ahead and consent to the life insurance being taken out on your life, which only makes a certain amount of sense. I think we hit that earlier. So we've talked about the benefits. The benefits is it's an efficient buy-sell solution. If we agree that business succession and buy-sell agreements, a will for your business is important, why not do it a smart way? Why not utilize life insurance with an LLC, because it will let you utilize permanent insurance to become independent of your own business, and will give you those tax advantages, including basis step up and be able to allocate those policy proceeds a lot smarter. It will minimize that premium inequity issue that we discussed, provides retirement income, and gives you, some of those basis step up advantages as well. So this is a buy-sell LLC. It's not a term of art per se. It's just a phraseology that I've given it. Now, if this is interest, just a second, if this is of interest to you personally for any of your businesses or anybody else that you know, let maybe Joe know. Then we have materials, white papers, one-pagers. We have this little client approved video vignette, which I should have thought to bring today, which would have been awesome to go ahead and show to the crowd, which will kind of step you through this. If you don't like my voice, we have a gentleman on my team who's just perfect for these. We use his voice for it. So if you're interested in this, please contact Joe and we'll give you more materials on it. There was a question over here.
I was just curious, could you, more on a personal level, if the home is owned by a trust,
Just like a personal residence?
yeah, personal residence, but it's in the name of the trust?
Yes.
Transfer of title into the trust,
Yeah.
could you do an LLC, lease or rent the home back to yourself? And would there be any advantage to doing that, doing what you're talking about?
Not necessarily. You want to make sure you had a business purpose for it, right? So, but if you're looking for a business purpose and you don't otherwise have an LLC, maybe it'll help in that case. So otherwise, not necessarily. I don't think that gives you any more extra leverage.
Okay.
Yeah. All right. Is that it? Okay, so that's the buy-sell LLC. A little bit of a different take maybe from some of the other discussions, awesome discussions that took place earlier. But I think it kind of illustrates the point of using permanent life insurance. Use some of those corporate dollars to fund your own retirement. And part of 401ks, there's nothing inherently evil with them, but the fact of the matter is they're ticking time bombs. Why not fund a smart asset like this using corporate dollars to supplement what you want to do, which is become independent of your own business?
I do have one more question.
Yes.
I missed this. So as these policies that you and I and Sue have build cash value,
Yes.
and we borrow against it,
Yes.
do you have to okay me borrowing money out of my policy, and do I have to okay yours and Sue and Bud, all live around?
Okay, so let's say all the policies are in the LLC. Nobody's. Yep. I'm looking for a mic that doesn't exist. So, no. I'll just project a little bit more. So, let's say we have the policies that are in this LLC, and we want to borrow against them, which is one of the reasons we have permanent life insurance. Does Sue, Steve, and I need permission from each other to do that? Was the question. All right. It's
And
not
also, on top of that, do we all have to do it at the same time, at the same dollar amount, or is it just so?
right. All right, you ask the advanced questions, you're going to get the advanced answer. If it was an S Corp, it would be a minor disaster because you have to more or less kind of work with one another under something called the pro rata rules. Long story short, with an LLC, if she wants to pull money out of her policy, you out of yours, mine out of mine, we can go ahead and do that. Now, there's a couple ways we can go ahead and do that. Our LLC membership agreement could be drawn up in such a way where we allow one another, upon you or Sue wanting to be able to pull money out of essentially their own policies within the LLC. The only problem with that is, are you endangering the potential buyout? So what if Sue pulls money out of her LLC and she dies? We heard from the speaker earlier, that could reduce the death benefit. And then there's insufficient death proceeds to effectuate the buyout, right? That's the only danger of that. So you can do that, but there's a danger to that. Then what you would probably have to do, if we're going to give her permission to do that, or you or I via the membership agreement, and she does that and she dies before paying off the loan, we're going to have a provision in that membership agreement that makes up the difference with maybe an installment note of some sort. So we're made whole again. Otherwise, we're endangering our own buyout. Okay. Awesome question.
Would there be a time limit on that too, in that case, in the agreement? Because I mean, if you do that loan and then there's never a repayment, so there's probably a time payment on that too.
Yeah, that might not be a bad idea. It'd give a lot of comfort for the remaining owners. You're still going to want to have an installment note as a backup, but that'd probably be a smart planning as well to have some sort of a cap on that. That's good. All right. Ladies and gentlemen, that's it. That's the Buy Sell LLC. Thank you very much. Yeah.